Hey everyone, welcome to today's Explainer. So today we are looking under the hood of literally the two most talked about assets dominating the financial world right now, stocks and crypto. We're going to go ahead and decode the exact differences between them.
A lot of people hear about stocks and crypto in the exact same breath, right? People just kind of lump them together as investments. But honestly, they are fundamentally different vehicles. They operate in totally different environments, they get their value from completely different sources, and they carry very different risk profiles. So to really understand how they might fit into your own financial strategy, we need to pull them apart and look at those basic first principles.
Let's start with stocks. When you buy a stock, you are actually purchasing a small ownership stake in a real functioning company. Think of it like owning a literal brick in a factory or maybe a tiny piece of a company's intellectual property. You're tied to a real-world business. If that company grows, makes more money and becomes more profitable, the value of your stock may naturally increase. And here's the really cool part. Some companies even share their actual profits directly with you, the investor, through dividends. So it's a very direct reflection of how that company is actually performing.
Now, cryptocurrency, that is structurally a whole different ballgame. The biggest thing to remember is that most cryptocurrencies do not represent ownership in a company at all. Instead, they're digital assets that operate on blockchain technology. So there's no central corporate headquarters, no CEO making decisions, no quarterly earnings calls. Instead of owning that physical brick in a factory we just talked about, you essentially own a stake in a global, decentralized software network.
And because their underlying structures are just so distinct, the way they actually generate value is entirely different too. A stock's value is driven by tangible things, company growth, actual profits, and those dividends we mentioned. But crypto's value? That is driven almost entirely by supply, demand, technological adoption, and honestly, market sentiment. It's super dependent on the crowd's belief in the asset and the network effects of people literally just using or adopting the technology out in the wild.
And as you might guess, these assets live in totally different ecosystems. Stocks are usually traded on regulated stock exchanges. They operate on very fixed schedules and are strictly overseen by government financial authorities. Crypto markets, on the other hand, operate 24 hours a day, 7 days a week. You want to trade at 4 in the morning on a Sunday? Go for it. Which is amazing for accessibility, but, maybe a little terrible for your sleep schedule. They also often face far less regulation, with rules that can vary wildly depending on exactly which country you're operating in.
All right, which brings us to perhaps the most defining contrast between the two, the volatility factor. Basically, expect major swings.
So let's talk about that exact volatility. While stocks naturally rise and fall in value based on, say, broader economic trends or specific news about a company, cryptocurrencies are generally much more volatile. It is not unusual at all for a crypto asset to gain or lose a massive percentage of its total value in a single day. A price move that might take a traditional safe blue-chip stock an entire year to make, that can happen in crypto before you've even finished your morning coffee.
So who are these assets actually for? Well, stocks often attract investors looking for long-term compounding growth and stability. They want a piece of an established economic engine. Crypto tends to attract a totally different profile. It brings in people who are seeking innovation, super high-growth opportunities, and folks who have a willingness to embrace the much higher risk that just naturally comes with emerging technologies.
But here is the grounding reality check. Absolutely neither investment is guaranteed to make money. Whether you're buying pieces of real-world companies or you're securing digital assets on a blockchain, both carry serious risks. The markets simply don't owe anyone a return. And really grasping the specific type of risk you're taking on, that's the absolute core of financial literacy.
Navigating those risks and actually achieving successful investing requires a mix of a few things: thorough research, immense patience, and a crystal-clear understanding of your own financial goals. You really have to ask yourself, are you looking for stability over decades, or are you aiming to capitalize on rapid technological adoption? Your timeline and your personal risk tolerance have to dictate how these assets fit into your life.
So just to summarize this all in really simple terms, stocks give you ownership in a company, while crypto gives you ownership of a digital asset, period. Understanding this foundational difference across what you actually own, when you can trade it, and just how wild the ride is going to be is the very first step toward becoming a smarter investor.
Which do you prefer for your future, stocks or crypto? Let us know in the comments.